Well, the minutes show a divided Fed that eventually came together on a larger than expected rate cut. While a substantial majority supported a 50 basis point cut in the benchmark lending rate, some participants preferred a quarter point reduction, and a few others indicated they could have supported such a decision. Several noted a 25 basis point move would allow the time to see the effects of a rate cut on the economy, and a few argued that it would signal a more predictable path for policy. There were a range of views, the minutes say, about how restrictive the Fed actually was. Almost all agreed upside risks to inflation had diminished, and most felt downside risks to employment had increased. A couple did not see an increased risk of significant further labor market weakening. Several, however, cited risks of sharper than expected slowing in consumer spending should hiring slow. The vast majority, however, did see inflation risks as broadly balanced. There was agreement that it was important to communicate that the recalibration of the stance of policy at this meeting should not be interpreted as evidence of a less favorable economic outlook or as a signal the pace of policy easing would be more rapid. Several also stressed the importance of communicating the ongoing reduction in the balance sheet would continue for some time, even as they cut rates. Matt and Kate?
And so we knew that there was going to be division. Of course, we had a dissent at the latest meeting. So interesting to see that sort of solidified in these minutes. Taking a look at some of the headlines here, of course, as we knew, some officials would have preferred a smaller rate cut, but most officials thought that risks of higher inflation had diminished. That was really the thesis of the markets, too, the consensus in the markets. We did see a little hiccup when it came to the average hourly earnings growth that we got last Friday. We have a big CPI report coming up tomorrow, Mike. I mean, what is the setup heading into 8:30 a.m. Eastern?
Probability of no cut.
Well, at least if you go by the minutes, most members are thinking that the inflation rate should continue to fall and that the risks that it would rise again had diminished. That's basically what's being called for tomorrow, a tenth of a point reduction in both the headline and the core. And if that's the case, basically it's something of a permission slip for the Fed to focus on employment in making its next decisions. And the risks at the time of the meeting, of course, were tilted towards the employment, towards labor markets. Of course, then we got last Friday the big jobs report. So it'd be interesting to see how or whether anybody had changed their minds about the risks given that.
Can we glean, Mike, from these minutes what the Fed might want to do, what some might want to do, or several, a few, couple, perhaps the vast majority, after we've seen these updated jobs numbers, better than any economists in our survey had expected, with revisions higher for the last 2 months?
Well, you really can't take any future forecasts out of these minutes because of the fact that we did get that big jobs report, and we do see ongoing strength in the economy. The GDP now number from the Atlanta Fed, 3.2% as of today for the third quarter. And if that's the case, then it was suggested if the economy is still growing strong and the neutral rate has moved up, they would want to do 25 basis points at a time as opposed to 50 basis points. There was no talk that they would suspend cutting interest rates, but at the time, of course, they hadn't seen these strong numbers. So it's going to be an open question. We'll have to listen to Fed officials as they speak between now and November and see if any of the numbers start to change their views of whether they should be cutting. But if they do cut, it does seem that most will be favoring going forward 25.
Yeah, let's talk about, of course, that November Fed meeting. We had a great conversation on open interest with Esther George, of course, former Kansas City Fed member there. And I know that you've spoken to her about what the neutral rate is. She thinks it should be slightly higher. We also got into a line of discussion about whether or not this could be a stop and start rate cutting cycle, whether or not we actually could see the Fed not move at all in November. I mean, Mike, what do you make of that?
Well, I think you would have to see a rise in inflation, something that would catch people's attention, or another extremely strong jobs report. But that's not likely, given what we're seeing with the hurricanes. The damage to the labor market, according to back-of-the-envelope calculations by J.P. Morgan Chase, is that we could see about 120,000 jobs taken away just because of Hurricane Helene. We haven't even had Milton hit land yet. And then, of course, you got 38,000 Boeing workers on strike. So put those two together, and you would have had a negative print had we come in at the level that had been forecast for September. So you've got a danger of a really low or negative number for the month of October. Now, the Fed would look through that, but with the American public, how would that play 2 days after the election? It's going to be a lot for Fed officials to think about.
We are getting inflation numbers tomorrow. The Consumer Price Index, which is not the Fed's preferred gauge, but does still have a wide following in the markets. We're expecting, I think, 3.2% at the core, 2.3% for the headline number. What will drive this number, Mike, tomorrow? What are the pieces that you're going to be pulling out of it as we get the report?
Well, generally what we have seen is an ongoing reduction in energy prices, and even though oil prices have gone up over concerns of the Middle East, we haven't seen that reflected in gasoline prices yet. So, and of course, the Middle East has only gotten worse since October began. So it's probably going to be energy that is one of the biggest contributors to the downside. But we've also seen weakness in airfares and hotels and things like that as we get into the school year, and a lot of travel sort of falls off. Used cars, new car prices have been going down. That may continue as well. But in general, what we saw the last time was a sort of broad decline in prices, and that gave even more hope to Fed officials as they looked at the inflation numbers that they were on the right track.